From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB on this Friday afternoon. I'm Nadine Blaney and it's a pleasure to be here with you as always on a really strong finish to this week with the CBO Australia Index up more than a percentage point. And look, the gains are pretty broad-based today. We still have to wait for the final figures from the S&P ASX 200, but the big banks, CBA putting on a further close to 2%. Hard to believe. Macquarie up by 1.5%. BHP, Fortescue, Rio, CSL. So all these really heavily market-weighted companies moving forward. Wesfarmers, Goodman Group, Transurban, Woodside. I haven't seen a day like this in quite some time. A little bit of weakness coming through in some names in relation to news, though, and that's the important thing. Some of the lithium plays also coming under pressure, but the biggest percentage point move to the downside and the upside actually related to trading updates coming from companies today. All right, we will keep our eye on that, and I'll revisit what the S&P ASX 200 finishes at, as always. And it's nice to have you here with us if you're watching live, on demand, or listening in podcast form. If you're a podcast listener, just a reminder that we have so many great interviews online at ausbiz.com.au. You can catch up throughout the day or throughout the weekend. We did a whole series on crypto FOMO this week. Also talked to some of the country's finest fund managers in relation to Futures Gen's 10th anniversary. And I happen to know there's a big soiree happening in Sydney this evening to celebrate 10th anniversary for our friends at Future Gen. All right, all-time highs. Well, we're pretty close to it here for the local market. I doubt we're going to get there today, but always on watch. Also on watch for six figures for Bitcoin. The craze continues. $100,000. It's in sight. Really, it could happen at any time, particularly when you consider that crypto trades over the weekend. And then milking profits, lapping it up. Investors loving the fact that A2 Milk is committed to paying a dividend come February. So that's one of the best performers on market today. Here is where the weakness came from, though, in terms of percentage moves from WiseTech. Weight on the overall market, down by 12 percentage point. I'll get you the news in just a moment. You can see their next DC also held its AGM down by 3.5%. So really investors voting with their dollars when it comes to some of the commentary coming from these updates. Technology won this week out with earnings, did cop a downgrade in the wake of it, but all on valuation grounds. It was up by 2.7% today, and Zipco keeps on zipping along. There's the energy space. We've got oil prices up on the ratcheting up of tensions between Russia and Ukraine. I spoke with a couple guests this morning, being Michael McCarthy from Moomoo, it's up online, and Ilya Spivak from Tasty Live about oil, Clifford Bennett as well. And it looks that this is, war premium in the price of oil right now. And of course that impacts the gas plays. The big miners, as I mentioned, all higher. South 32, that's a good lift there, up by about 3%. And getting across the top stories, A2 Milk, as I mentioned, the top gainer after lifting its revenue guidance and saying that it will start paying dividends thanks to stronger than expected sales and higher dairy prices globally. But WiseTech, you're really getting hit after it downgraded both revenue and earnings for FY25. Bit of a product delay or launch delay, and also, like the commentary around the CEO and his behavior certainly not helping matters. So this is the biggest fall we've seen for WiseTech today since August of 2023, so more than a year. Lovisa started out in the doldrums, but as I was chatting with some of my guests today, it looks as if it was a bit of a knee-jerk reaction at the beginning. It did miss on 3 of the main metrics, according to RBC Capital, and that's missing market expectations, not RBC's expectations. But look, it's still opening stores in far-flung places like the Ivory Coast, Congo, and Panama. Those were 3 of the stores that are being opened. So interesting there. Ended higher. Kogan initially reacted positively to the news coming from the trading update that it put out. But again, you can see settling lower. At one point today, it was up as much as 7%. So it's looking at gross sales of $2.59 million, for the July to September period this year. And Megaport. So Megaport is also suffering today in the wake of an update coming through at its AGM. It did reaffirm its guidance. So I was a bit surprised by the magnitude of the falls, but I'm just reading a little bit of a note from UBS saying that its outlook remains in line with estimates, but FY26 guidance looks to be a bit of a downgrade compared with market expectations. Ongoing investment into headcount could also impact market expansion, UBS says, into FY26. It has a price target of $10.15 on the stock and has retained its neutral rating. So those were some of the big corporate news moves today. Let's get across what it means for investors from a top-down perspective, and a warm welcome to the COB, Shane Oliver from AMP. Shane, nice to see you. Thanks for joining us. Are we any wiser this week about what the RBA is planning to do come February?
I would say no. To be honest with you, I regarded the minutes as quite confusing. And you can see that in the different reactions of economists. Some people latching on to the comment that the Reserve Bank needs to be forward-looking, not focused on backward-looking data. And of course, you could argue that inflation numbers are backward-looking. But then, of course, alternatively latching onto the comment that if inflation came in on the low side, on the good side, they'd want to see two good CPIs in a row. And they're referring to the quarterly numbers. And presumably, we haven't seen a good one yet. So that means we need another 6 more months or so before we can be cutting rates potentially in May after the March quarter numbers come out. So, and that of course has pushed some economists to push back their rate cuts out to May, some of whom only just a month or two ago had brought them in from May back to February. So a lot of switching around here. I find the minutes seem to be getting longer and longer. Every possibility, every perturbation is put in the minutes these days, and you can read into it what you want. I think ultimately the Reserve Bank will still remain data-driven, but you have to concede we have seen some good numbers in terms of consumer sentiment, business confidence last week. That arguably, and strong jobs numbers, remove some of the urgency to cut. Against that, though, the inflation numbers have been going the right way, and the wages numbers have been on the soft side, which you could argue brings them closer to a cut. But at the end of the day, I don't think we're any wiser than we were last week as to when the RBA will cut.
Yeah, interesting that, isn't it? I guess there's more minutes, a 2-day meeting, but I sort of got the sense that it was a on one hand, on the other hand type scenario.
That's right.
It's a sure bet, though, is it, that the RBNZ will cut next week? I heard somebody, and I was just looking through my calendar to see which guest mentioned it to me, that there's actually some pricing out there for a 75 basis point cut coming from the RBNZ. Is that possible?
It's certainly possible. The NZ economy is looking decidedly weak. Unemployment has been going up, of course. Inflation has been coming down relatively quickly. The RBNZ was perhaps the most hawkish or most aggressive of the central banks in terms of tightening. And it is quite conceivable that they do 75, although my bet would be on 50 basis points. I think currently 4.75, cutting that down to 4.25. So it only just gets them back to where the RBA is right now. But there is some chance it could be 75, but I think not. You just got to also allow, this is the problem for the RBNZ, after this meeting, I think they don't meet till February. So, almost 4 months before the next meeting out in New Zealand. And that's why you could argue, well, they may want to do a big move because the economy is weakening and they don't meet over that lengthy period going out to February. So there is an argument there to do more, but I'd probably lean to 50.
Yeah, okay. Of course it's possible, but likely, although that would certainly get people to sit up and take notice. So this is a question just to get your view, Shane. So if you've got the example of the RBNZ, obviously hiked faster, further than our RBA, but has obviously been forced to cut in a swifter manner, more severely because of the more severe slowdown. I mean, that's what it's in response to.
Yeah, that's right.
Well, our own central bank did not hike as high, but they've obviously not had to cut as swiftly because the economy is, still motoring along relatively well. Which is the better scenario?
To be honest with you, I'd say the Reserve Bank. The Reserve Bank has been more cautious. And if you compare New Zealand to Australia over many years, you've often found that the RBA is somewhat more cautious, less aggressive than the RBNZ, which seems to me to swing from one extreme to the other, and often finds that it ends up going too far, and then it knocks the economy into recession, and then, of course, goes too far the other way, and then has to tighten aggressively. So I'd probably come down in favour of what the RBA has done. I think, in the benefit of hindsight, and of course they've been assessing it along the way, they've done a reasonably good job. I mean, the fears I had that the economy would plunge into recession hasn't quite happened. Certainly hasn't happened. We're not in a recession, although I think many people out there would think, well, maybe we are. And if you look at per capita GDP, you could argue, well, we are in recession on that basis. Of course, we've been helped, I guess, to some degree or hindered by very strong population growth and very strong growth in public spending. So therefore, the economy hasn't been hit as hard. But by the same token, if at the end of the day, the RBA has been able to hang on to most of the job gains. In fact, the jobs market's still strong. Unemployment's still down there around 4%, just above. And yet inflation is coming down. I'm not overly negative on Australian inflation. When I look at it, I think it is coming down nicely. And if you look at core measures or underlying measures around the world, our underlying rate just above 3% on the most recent monthly readings is basically where it is in the US and the UK. And we've got similar unemployment. So all up, I'd have to say, looking back over the last couple of years, the RBA has done a pretty good job, particularly compared to other central banks that I think have gone too aggressively, particularly the Reserve Bank New Zealand.
All right, good. I'm glad I asked. Now, Shane, taking a look around the world and you look at equities, well, arguably, valuations for many companies are quite high, but we still seem to be in this Goldilocks scenario. Will the momentum for equities continue?
It probably will. I mean, this week's been another amazing week. We've had geopolitics back on centre stage again around Ukraine. Markets, the US share market did briefly take notice, I think, on Wednesday. Initially, the US share market hit a low of 0.9% as measured by the S&P 500, but it then closed up flat, just moved on to other things, as is often the case. I think markets have sort of rightly come to the view that, there's a lot of huff and puff around these geopolitical things, but unless they actually impact oil or spill over into other countries in Europe, then at the end of the day, it's just another war. That's the way markets look at it. I mean, I look at it and think that it's horrible. It's horrible for the people involved. Markets they're not focused on those things. And, I think what's happening in Ukraine is really just both sides positioning ahead of potential negotiations next year with Donald Trump. So they're both trying to strengthen their hand going into that. And that's the way it should be seen, rather than necessarily a big escalation causing a major conflagration around the world. But if you look at markets, on the one hand, you do have stretch valuations. As you mentioned there, we're seeing increasing signs of euphoria. You could regard Bitcoin as an example of that. Someone paying, was it $9 million for a banana?
Yeah. Stuck
to a wall. I mean, it just shows how stupid things have become. That sort of stuff is indicative of euphoria. That is a bit of a concern. Flip side, though, against those things is that you do have this Goldilocks scenario. Economic growth globally just keeps keeping on. It's modest. It's not fantastic. Our treasurer keeps complaining about it, but it's not that bad. And inflation is still trending down, albeit it's 2 steps forward and 1 step back in most countries, including our own. And central banks are still on track to cut rates at a gradual pace, which overall is still not a bad outlook for markets. And I think it's probably going to be much more of the same next year. We'll probably see some somewhat bigger corrections or volatility as we go through the year, because Donald Trump's going to create a few surprises along the way. But broadly, the outlook still looks reasonably good as far as I can see it. But you have to allow that the rates of return are not going to be the same. We're up 9% to date in our market. I think it might be 10% after today. That's 14% with dividends, close to 15% with franking credits, 25% in the US. You can't expect that to continue. I think we're going to see a more constrained ride. I think we're going to see more volatility, but the broad picture will still be a positive one for investors.
Okay, just a quick one before we go. Next week, we have monthly inflation data here. We have the PCE in the United States. We've got Michelle Bullock, the governor, speaking at a CEDA event. What's most interesting to you?
That's a good question. I'd probably say the monthly CPI in Australia. The core PCE in the US will probably show a bit of an uptick, given that we get so much information on that from the CPI, the PPI, import prices in the US. Most economists have worked that out. It's going to show a slight uptick from 2.7% to 2.8%. So not calamitous, but we are going through a somewhat elevated phase. But I think as we go through next year, we'll see a further leg down in US inflation back down towards target. But I don't see great surprises on that one. In terms of Michelle Bullock, I think she will reiterate the message that we've seen in the minutes and the statements and so on, that they're still looking at all the things that could drive them in either direction, but right now they're sitting tight on monetary policy. CPI, I think, will interest me because, rough as it is still called an indicator, like something economists put together to try and guide what the actual CPI might be. So it's not perfect. It doesn't have all the components, particularly the first month of each quarter. It doesn't have all the components, particularly in terms of services. But if it maintains that downtrend that we were seeing in both not only the headline rate, I think it might uptick a little bit from 2.1 to 2.2, but still in a nice downtrend. But most importantly, if the trim mean, which I think on the most recent number was 3.2%, it could uptick a little bit, but I think that broad trend will continue down. And that'll be what I'll be focusing on, the trim mean component in the monthly CPI. Could go up a little bit, maybe 3.4. It's still consistent with that downtrend emerging as we go through the quarter, and probably ending up lower than the Reserve Bank is forecasting for the quarter as a whole, which is 3.4%. Now, interestingly, that comes out on the Wednesday. I think Michelle Bullock's comments come out after that.
I think it's Thursday,
Thursday. So she may provide some update in relation to what that means, what the monthly CPI means, but that it's not their primary focus. The primary focus is the quarterly, but in terms of what we've got out over the next week, it's probably going to be the most interesting thing, at least in terms of us sitting here in Australia wondering when interest rates are going to come down.
Well, Shane, you are so good to join us at this time every Friday when I know you're probably just itching to turn the music up, maybe even get outside. An absolutely glorious day in Sydney, so we'll let you go enjoy it.
Perfect day.
See you, Shane. Shane Oliver there, Chief Economist, AMP. Now, our stock of the day was Lovisa. Andrew Gagan caught up with Daniel Ortiz from Stock Doctor and Henry Jennings from Marcus Today.
Are a few talking points at the moment with Lovisa. That's why you've seen, in particular, the multiple D rate, but it still does trade a significant premium to its peers. We think that has been justified given the growth, given the quality of the business and its management historically. But now, the market's going to have to decide, what is the right price to pay for Lovisa. The growth is slowing, therefore the multiple should be lower. I do like Lovisa, I've got to say. I think it's one of those stocks that I wouldn't say is immune to economic times. I mean, it's the whole lipstick thing, but their customer base is not really the ones that are out there paying mortgages and have got big student debt. They tend to be a somewhat younger cohort, shall we say, and their margins are extraordinary, and it is cheap and cheerful jewellery that satisfies the new generation. So I don't have a problem with it, but obviously the market a little bit underwhelmed. If you've got it, you wouldn't be selling it. If you're new to it, I think you could probably wait.
Now you can listen to their full analysis online at ausbiz.com.au. At the top of the screen, there is a series called Stock of the Day. Now, you would be living under a rock if you've not seen any advertisements for Black Friday. Well, what follows Black Friday is Cyber Monday, and Black Friday is actually on the 29th of November, so the following Monday, that's December the 3rd, we'll be hosting an investor event, ausbiz.co/cyber to register free. So some of our expert guests will be putting forth an equity that they believe is on sale, essentially undervalued, and offering significant upside. So I don't think you want to miss it. It's free, as I said, ausbiz.co/cyber. Here are some of the market leaders today. We already talked about A2 Milk, energy in focus, particularly uranium, Deep Yellow, Paladin, Sigma Health. Well, I just think of it as Chemist Warehouse now, but anyways, Pinnacle Investment as well, looking to raise capital to deploy some growth options at the funds under its umbrella. Some of the laggards, though, and look no further than WiseTech. We've talked about that. Megaport, AGM, Pilbara, and Audinate down by 5.75% apiece, and Tabcorp. Into the small to medium end of the market, DRA Global. No idea what that company does. Now I'm curious. I would love to look into it. See if there's any news. None that I can see. Up by 25%. Flipping the page to the laggards in the small to mid-cap space of this market. And Legacy Iron Ore, Visarn, and Talga Resources all down significantly. Talga 6.5%. So what's happening tonight in the United States? We get global PMIs. We get the University of Michigan Consumer Sentiment Index, always worth a read. Particularly when we've heard from some of the retailers in the US this week. Target was tanking after it warned on shopping going forward, but Walmart did really well. In Europe, we get those PMIs as well. So in the week ahead, we heard our mate Shane Oliver from AMP talking about RBA Governor Michelle Bullock. We get private sector credit. We get that monthly consumer inflation read. We get construction for October and work done. So some of those GDP partials coming in. And we get an interest rate decision in the United States, New Zealand, as we talked about with Shane. The FOMC meeting minutes from the last meeting are out. GDP in the US, core PCE, and we get manufacturing indexes from Dallas and Richmond, Virginia. Here we go. Here's a final look at the CBO Australia Index. And taking you to the S&P ASX 200, it did finish well into positive territory as well. So sitting up at 8,000, come on, here we go, 8,394, up 0.8, close to 0.9%. Week to date, this local market is up 1.3%. Month to date, close to 3%. And to Shane's point, year to date, the S&P ASX 200 is up by close to 10.5%. E-minis in the US coming under pressure as this European session looks to get going. We will keep you informed of all the weekend brings when we are live once again at 9:45 Monday morning. Look forward to seeing you then. In the meantime, though, catch up with everything you may have missed, ausbiz.com.au. Have a happy and healthy weekend.